Welcome to Africa Business Weekly. I'm your host, Aki Obake. Now let's dive into this week's top stories and explore what's shaping the future of business in Africa. Let's start off in South Africa, where fresh concerns mount about the state of the country's economic growth momentum as hopes for a second-half rebound gains momentum. In East Africa, we'll touch on the MPC meeting in Rwanda and budget presentation in Kenya. In West Africa, S&P Global Ratings has something positive on Ghana's economy. But let's cross over to Johannesburg and get updates from Karabo.
Thank you, Akin, and good evening to you. The Bankserv Africa Economic Transactions Index dropped to its lowest level for the year in April, raising fresh concerns about South Africa's economic momentum. But despite global headwinds and low confidence, economist Elise Kruger believes there are structural tailwinds that could support a second half rebound. CNBC Africa's Nomonde Kulu spoke to her for more.
We've got a bit of a disappointing number from the Betty in April. And I think we had a month where we were faced by the US Liberation Day announcements with quite punitive import tariffs announced by the US. That has resulted in an evolving trade war. We have seen volatility from day to day, markets plunging. We've seen our economic growth numbers being revised lower, both globally and locally. So all of those factors in April, quite a significant shock in terms of confidence levels. And I think that has resulted in this lesser economic activity that we saw in the numbers of Banks of Africa in April.
I mean, of course, post-April and most recently, we've seen a little bit of easing in those tensions, particularly between China and the US. Are we seeing any early signs that those recent trade deals could ease global volatility and support a recovery in local sentiment?
Yes, indeed. I think just in the last day or two, actually the last week, we've started to see markets reacting as a first line of reaction to that, recovering from some of the losses of April. So yes, indeed, I think what has been transpired as a de-escalation of the trade war will be positive, from the point of view of confidence. However, I think as much as we've seen two big countries come into the party in terms of deals here, there's still a lot of the other countries that have not yet announced anything. And as we know, the US has basically kicked that can down the road for 3 months. So come early July, it will be also still, I would say, an uncertainty to know what the US will do after that 3-month reprieve that was announced at the time, or a few days after the initial announcement. So there's still uncertainty. And I think the way that we have started to see the US announcements, today it is this news, tomorrow it's something different. It still has created a layer of uncertainty in terms of the way forward. But yes, indeed, I think what have been announced have helped to alleviate concerns somewhat. But there's still, I would say, quite a bit of a foggy view about the full impact of what has been announced.
Going back to the April Betty number, despite the headline dip in that number, the year-on-year comparison is still quite positive. Are there any underlying resilience factors worth highlighting?
Yes, indeed. Betty is still up by 1.5% on an annual basis, despite the fact that the monthly number has crept lower. Really some structural tailwinds in the economy that should help the economy overall and economic activity as we move throughout this year. And here I'm thinking about our inflation rate at fairly low levels at the moment. Our headline at 2.7% is below the 3 to 6% target band of the Reserve Bank. We should see those next couple of headline CPI numbers remaining below 3%. So that has helped on two fronts. On the one side, it has definitely opened up a window of opportunity for the Reserve Bank to cut interest rates further. We are at this point in time, stuck with fairly high real interest rates, quite punitive for an economy that is struggling to gain momentum. And on the second avenue, the positive impact is also on wages. So if you think about average salary increases of between 5 and 6%, and an headline CPI average of just above 3%, so 3.2, 3.5, you are talking about a second consecutive year of real wage increases. And that additional purchasing power in the pockets of households will be an important factor driving growth in South Africa, despite what's happening globally.
In more news down south, Cape Town this week played host to a landmark global gathering that is the 2025 International Forum of Terrorism Risk Reinsurance Pools Conference. As terrorism threats and political violence evolve, so too must the solutions. For more, Nomonde Xulu spoke to Mpumi Tikwe, who is the CEO of Sasria, to unpack why Africa is now central to the global risk conversation and what this moment means for the continent's future resilience.
It's an opportune time for us to be hosting this event. For first, as you know, South Africa will be hosting the G20 for the first time. We are having global leaders meeting here towards the end of the year. And we felt that it was an appropriate moment for us to bring global thinkers and experts in the world of managing terrorism and political violence risks in the world. So we have here in Cape Town no less than 13 nations represented, and we are sharing ideas as to how we can manage the emerging risks that are coming through in the world. As you know, the world had transformational elections over the last 13, 14 months or so. The latest elections being held in Australia. Before that, we had Canada. And of course, in November, we had the US elections. And South Africa, we had the May elections. Those elections brought about certain outcomes that really change how we see the world or what's happening in the world. For instance, in South Africa, for the first time, we have a situation where we've got a coalition government since our independence. This is happening for the first time. Secondly, in the US, there was a particular outcome which brings uncertainty as to how the US will respond should NATO member countries come under some form of attack. We've got the issues of tariffs that have been introduced, which are affecting economic growth of countries. And what we have in Africa, which is unique and which the world needs a lot of, is this demand for rare earth minerals, which are pivotal for technological advancement. And secondly, uranium, which is critical for energy.
You've touched on some of the things that sort of make Africa very relevant in the global context. And with this conference coming to Africa, it puts Africa at the center of the global risk conversation. What trends or shifts are putting the continent in the spotlight?
Well, as I said, for instance, there's going to be a demand for resources in the world to drive technological advancement. The next frontier in the world is in the world of AI and digitalization. Those are energy intensive industries and technologies which are going to require energy, and uranium is a key part of that. And where do you find uranium? Mostly in African countries. And this demand is going to create, there's a competition in the world as to who becomes number one in ranking. The competition, for instance, between the US and China around economic development and the demand for these particular goods. So that's the first part. The second thing that we have seen in Africa, in particular around terrorism, if you look at Central and Western Africa, there's been a growth of incidents of terrorism. Now, as Africa, how are we going to manage this particular risk?
And those were the stories driving the southern tip of the continent. You can, of course, revisit these stories on our website on cnbcafrica.com. But for now, it's back to you, Akin.
Thanks, Karabu. Let's join Tabitha now in Kigali as she gives us updates from East Africa.
Thanks, Akin. In East Africa this week, Rwanda's Monitoring Financial Stability Committee held their first meeting and the newly appointed Central Bank Governor Soraya Hakuziyaremye. The National Bank of Rwanda kept its benchmark lending rate steady at 6.5%. CNBC Africa's Abiagina sat down for an exclusive interview with the governor. Here is more.
The National Bank of Rwanda, which is Rwanda's central bank, and our Monetary Policy Committee decided to maintain the central bank rate at 6.5%. And the reason behind that is, one, the projections that we're seeing for inflation, which is projected to be around 6.5% this year and decline in 2026 to 3.9%. But there are risks to that outlook. As you know, we are in a world where uncertainties have heightened, mainly due to change in trade policies with the announcement of US tariffs, retaliatory measures by US trading partners, and the pause in those tariffs. So that doesn't give us yet visibility on what the impact will be on inflation. But for us, we think that 6.5% as central bank rate is adequate level to keep our inflation between our target band, which is between 2% and 8%.
A lot of market watchers were saying this was expected, and perhaps looking at the road ahead for the bank, we've seen a lot of pressure coming in when it comes to the trade deficit. How is the bank addressing this? Is it a priority?
And so the trade deficit per se is not in our mandate, but when we look at, of course, what that trade deficit means for, one, pressures on the exchange rate, but also what that would mean on imported inflation. That's where, our attention tends to look at trade deficit. We've seen that in the first 3 months of 2025, the trade deficit widened by 10%, and this was mainly due to an increase in imports of 5.8%, moderate increase, but the exports slightly declined by 3%. But what is important to note is that imports were mainly for capital goods, so machinery going to our factories mainly, and also raw materials for our industry. So these are not imports that would worry us much, because we know they are imports for investment and future output in our economy, future products that will be in the market, but also that can be exported. But that trade deficit has to be balanced with inflows of foreign exchange we've seen being on the FDI part, on remittances that continue to increase, as well as good performance of the services sector and trade-in services, where we actually have a surplus. And so with all that, our foreign exchange reserves are really at a very satisfying level, above 4.5 months of imports at the end of April. And that, gives us comfort that if there were any additional external shocks, we are able to mitigate its impact.
All right. And Governor, before I let you go on this particular issue, of course, a lot of global players are watching what's happening between US and China. And many are also looking at how is this likely to impact African markets from where you sit. And as a central bank, are you concerned about this?
There are obviously concerns. When there's any trade war, it's never good for the stability of the global economy. And you've seen that actually the announcement of tariffs have led to a downward revision of global economic growth to 2.8% now.
We also tracked key market developments across the region, and into the Horn, Ethiopia's fiscal year 2024-25 federal budget drew significant attention, crossing the 1.5 trillion Ethiopian birr mark for the first time. I spoke to Meredi Fikere Yohannes to look beyond the headline numbers, unpacking the structural shifts, fiscal risks, investor sentiment, and the geopolitical implications of this record-breaking budget.
For the first time, it is a record break to see the Ethiopian government to spend 1.5 trillion birr. So to give you a context, Ethiopia has taken a significant macroeconomic reform starting from July 2024, which was the fiscal year started. Now we are in 10 months of the fiscal year. So the budget is going to be ending by end of June, right? So one of the biggest fiscal reform that we did was floating the birr, at least correcting the forex prices in terms of from the official rate also to the parallel market where the price of birr has, it used to be 58 birr, okay, before we float the currency. Now it's hovering around $1 for 130 birr. So that is reform started back in July 2024. With that in mind, and then Ethiopia is also going under debt restructuring in terms of both internally and also externally. So with that, one of the biggest things that the government has done is it has to buffer its cushion. So in order to buffer its cushion, the government had to revise the fiscal spending from the initial spending was around, the total spending was around 950 billion birr, but the government with the reform and also with the float of the currency, it also created a lot of pressure on the government balance sheet. So they had to revise it to 1.5 trillion birr. So that 1.5 trillion birr, and if you've seen it in the past 9 months of the fiscal year, the government was planning to garner a tax revenue of 900 billion birr with an estimated deficit of around 450 billion birr. That was the plan. So far, the government has garnered around close to 620 billion birr in the past 9 months. And mind you, and as part of the economic reform, and we have floated the birr, and one of the most important fiscal discipline that the government has taken was in this fiscal year, I could say this confidently, for the first time in the past 5 decades, the Ethiopian government has not taken any monetary financing or new money been taken out from the central bank, right? This is a huge shift from a fiscal policy perspective. Obviously, that has created a pressure on the government side, which you get that which the market has interpreted that pressure in terms of the government collecting tax as soon as possible, especially with the fiscal year starting since July 2024. It used to be 3 months that each businesses they used to declare their sales tax, but they revised it to 1 month. So that created a lot of pressure on the business side and also from a consumer side, because the government need to collect cash as much as possible from the system so that it could sustain this big spending, right? So it is one of the expected pressure which came from the fiscal side, because the government did not print any money or new money has not come in from the central bank to the Ministry of Finance side. So that was a huge shift. So in terms of the biggest shift, I think, is in Ethiopian fiscal policy is most of the income the government gets is from customs duties, right? So because you floated the birr from 58 birr to 130 birr, immediately you get that effect in terms of you get the government coffers in terms of that you get from customs has gone out significantly up. However, of course, you see that since our tax base is very small, you're seeing the tax pressure on the business community and also on the consumer side.
That wraps up the region's markets roundup. For more, visit our website, that is at cnbcafrica.com. It's back to you, Akin.
Very insightful conversation there. Thanks, Tabitha. Now, S&P Global Ratings says they could raise Ghana's ratings in the next 12 to 18 months if the country makes progress in stabilizing public finances and reducing its debt service burden. S&P recently raised its foreign currency sovereign credit ratings on Ghana to CCC+ from selective default with a stable outlook, stating that advanced talks between Ghana and its remaining commercial creditors reflect its forward-looking opinion of the country's creditworthiness. Ravi Bhatia, director and lead analyst at S&P, joined us earlier for this discussion.
So Ghana defaulted back in December 2022. And then they quite quickly started engaging in restructuring talks. And October last year, October 2024, they restructured their Eurobonds. And at that point, we took the Eurobonds off default and put them onto CCC+. And now they've made further substantial progress on dealing with commercial bank loans. And they're working with their bank loan lending to restructure those. And on the basis of that, we've taken the entire issuer credit rating, that is the full rating for Ghana, off SD and put it on CCC+ with a stable outlook. So, substantial progress on the restructuring effort, and that's why we've moved. And more fundamentally, I mean, the economy has also, from a growth point of view, has been doing well. There was strong growth last year. The gold prices are supporting the story. Unfortunately, they've had fiscal pressures where they built up arrears tied to the elections at the end of last year, but they're working through those with the support of the IMF. The economic prospects look good, but fiscal has to be put under control.
Yeah, but how critical would you say is the conversation or the resolution of the commercial creditors' negotiations are to maintaining the current rating or even achieving an upgrade?
It's important from, we're watching them in the negotiations with the creditors, and they've given a good faith offer, and the expectation is, the vast majority of the banks will accept that. So they're working through the negotiations in good faith, and that supports our action that we took. And now that we're off SD, it's really a case of they must, they carry on with negotiating and settle, come to a settlement on these bank loans, and then also make progress on the economy and on fiscal consolidation across the board, which they're working with the IMF.
Yeah, because I was going to get to the issue of fiscal consolidation here, and we know that despite this upgrade, that Ghana is still facing those high debt service burdens here. And how does this risk factor into your more or less longer-term credit outlook for Ghana?
Yeah, I mean, they had this big deficit last year tied to the elections, where actually on a balance level, the deficit was broadly in line with the expectations, but they built up significant arrears on projects and supplier arrears. So that if you look at it on a commitment basis, the deficit was significantly bigger than planned. So they're looking at those commitments and assessing them.
Meanwhile, analysts believe the move by the United States to lower tariffs on Chinese import to 30% for 90 days marks a dramatic pause in a trade war between the two nations as shares of semiconductor and chip companies continue to surge. What's the implication for investment in African countries as both nations compete for influence and resources? Yen Choi, president of Netcom Africa, joined us for more on this conversation and how Africa could help diversify the booming global semiconductor industry. Take a listen.
I think it's very good. It brings a bit of stability into things and more predictability, but ultimately, as you said, it's just a pause. So does anybody know what's really going to happen in the future? It's a bit hard to tell, but what I do know is that the strategy that different countries will take globally in terms of how they view global trade will now change.
And I was going to go to that. I mean, what are the key lessons that you think countries perhaps overall are taking away from all of this? Maybe like a recurring theme from all of this?
Building national domestic capacity. That's the key. Whether it's in creating new services, doing manufacturing, exporting services, whatever that may be, but building that knowledge within the country is going to be key.
Now, for the semiconductor market, it's expected to, according to analysts, hit about $1 trillion in valuation before 2030. Now, we know that obviously, I mean, the Asian countries, obviously, when it comes to, they're like the major hub. But there have also been conversations about where Africa fits in all of this, in the value chain. Obviously, still at the bottom, but we know that Africa's reach with when it comes to things like minerals like silica, rare earth materials. Even Nigeria, we do have large deposits of that, but it's still the perspective is still one of extraction. How can Africa at a time like this begin to position itself, for perhaps become a hub?
Well, with manufacture of microchips, they're built in a semiconductor fabrication plant. And most of these companies are either domiciled in North America or in Asia. But there's nothing to say that we have to come up as Africa, these plants on our own from zero. There's a partnership opportunity. And if, for example, a semiconductor manufacturing company decides to set up a plant in Nigeria, that becomes a made in Nigeria product.
What other key lessons can Nigeria take from Asia, from China, for instance, in terms of how to boost and just getting getting it off the ground, getting structure. Yes, we can have companies come put factories here, but from also domestic perspective, what can we do?
I think the fastest way to become first place is to go to second place. So partnering up with companies, gathering knowledge, information, and the people that would be working in those companies would be going through the ranks, learning very fast at an accelerated pace. And those people will now be able to run those organizations, branch out, create their new companies to do, whether it's semiconductors, electronics assembly, circuit boards, whatever that may be, to now create that industry on the ground. This has happened many times before. China was lagging in terms of technology several decades ago, partnered up with many different companies. They didn't want to be the best, but they want to build capacity. So capacity building through education, capacity building through commercial partnerships.
Now, at the heart of this, not just at the heart of it, one of the reasons why all of this is happening is the dominance now. Almost every conversation is all about AI. The race to who can put out the best, as it were. U.S., China, and other countries. But talk to us in terms of how you're thinking about how it's all taking shape. We hear of companies trying to. Of course, there was that story with Nvidia and all of that, and China and all of that. Don't want to get into that, but just how are you thinking about that and how that is transforming the global economy, how that is transforming how we're going to live our lives in the future, and also I always would have to mention Africa, how Africa can also take advantage.
Well, everybody knows AI is the next big thing, and AI requires chips. Everyone knows NVIDIA. Just because NVIDIA is part of the story. Right. I just read the other day that NVIDIA is planning to move its headquarters to Taiwan as well. So there's this shift. But if you peel all the layers, the actual equipment to make semiconductors, a lot of it's from, for example, Japan, it's from Europe, it's from all across the world. It's just a company has decided to put those technologies together to create a manufacturing plant.
And this is where we draw the curtains on this episode of Africa Business Weekly. Thank you for joining us. Now you can catch all these on cnbcafrica.com, all stories and more. Until next time, stay informed and stay ahead. I'm Akin Obakeye.